The financial markets continue to digest the implications of the policy meeting of the US Federal Reserve that took place on the 18th of March. Chairman Janet Yellen dropped the word patience from the central bank's carefully crafted outlook statement. As a result, the bond market now expects the first American interest rate increase to come in December of this year rather than June. Now, the Bank of England's Mark Carney has also dropped forward guidance and begun to dance around when the UK central bank will first hike borrowing costs. The gilt, or government bond market, is currently looking for the first interest rate increase late this year, early next. Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this week's Breaking the Mould, I'm going to try and cut through the central bank speak and look at what monetary policy can mean for markets, particularly if history's any guide. We've therefore analysed every interest rate cycle in the UK, and actually the US for that matter, over the past 45 years. Now please bear with me, it is interesting. As global bond and share prices continue to bask in the warm glow cast by record low interest rates, we've come up with three conclusions to consider. First, the UK stock market has performed best when interest rates are going down and worst when they've been going up. This all makes perfect sense. Rising returns on cash lessen the appeal of other riskier asset classes, which also look more expensive once the effect of higher interest rates is factored in to long-term valuation tools like discounted cash flow or DCF models. In sum, during tightening cycles, the FTSE All-Share has returned 6.5% on average in capital terms, excluding dividends, against an average advance of 26% when rates have been going down. Second, the traditional relationship of markets doing less well during rate hikes and better during rate cuts has actually begun to break down of late. Over the past 4 rate cycles, 2 up, 2 down, UK stocks fell initially when rates were cut and rose initially as borrowing costs increased. Now perhaps markets were simply overshooting in response to money being made too cheap for too long, and it took a sustained period of higher borrowing costs to pop first the technology and then the property bubbles that had formed. This may be a cautionary tale for those who believe in the infallible power of central banks to influence markets. Now thirdly and finally, peaks and troughs in the interest rate cycle have become progressively lower, as you can see here. Now this may reflect how the globe's debt burden continues to grow, and therefore that the foundations of the longed-for upturn are still a bit shaky. We could be in for a prolonged period of low growth, low inflation, meagre returns on cash as interest rates stay low, with all the implications for asset allocation and stock selection this brings. Such a scenario also begs the question of what happens next time there's a recession, because believe me, there will be one. Some of you may even think we're sliding back into one right now. Now, whatever the circumstances, no doubt central bank policy wonks will devise new monetary tools, but how effective they prove remains to be seen, especially when the global economy is still battling for genuine traction nearly 7 years on into the period of record low interest rates on both sides of the Atlantic. Anyway, in sum, watch what central bankers do, not what they say. They're only human. Policy error is perfectly possible, so build your portfolios to suit your long-term goals, target returns, time horizon and appetite for risk, and not according to what the monetary authorities may say or do. Thank you for watching, and I look forward to seeing you next time.